Hello viewers, welcome to my channel. I'm Hasham. So now I'm going to start from 11th problem. 10 problems I have completed till the last video, where we have computed the tax liability under different situations, applying the slab rates, applying the flat rates, etc. So if you want the perfect knowledge, watch all the videos one by one. Otherwise, if you join in between, you will not be able to understand, because so many provisions are there under the Income Tax Act. Every problem will be a unique problem. Some different points are given. So now I'm going to start the 11th problem. But before that, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take a screenshot of the solutions from 11th to 15th problem. Then I'll explain. Come on. See the 11th problem. Sri Kalidas Tilak, an Indian citizen but non-resident for the previous year 2020-2021, relevant to the current assessment year 21-22. During his stay in India, he won a lottery prize of 3.5 crore. First of all, the SSC is a non-resident. Income Tax Act says whether the SSC is a resident or non-resident, casual income is fully taxable. How much is the casual income? 3.5 crore. Lottery, winning from lottery. Winning from lottery is a casual income on which there is a flat rate of tax, 30%. Plus surcharge, plus health and education cess. The only new point, he is a non-resident. Even for non-resident, tax is fully applicable. That's it. Current assessment year is 21-22. For this assessment year, the previous year is 2021. Sri Kalidas, residential status of the SSC is non-resident. Whether the SSC is a resident or non-resident, casual incomes are taxed at a flat rate. No difference. No basic exemption is given. For casual incomes, no basic exemption will be given, whether resident or non-resident, immaterial. So, tax on casual income, 30% of 3 crore 50 lakh. 3.5 crore means 3 crore 50 lakh. So 30% comes to 1 crore 5 lakh. 1 crore 5 lakh is the basic income tax. To this we add surcharge. Because the income is more than 2 crore but less than 5 crore, the surcharge rate is 25%. Last so many problems I have explained. And again, I am suggesting you to keep a notebook beside you while watching this video. Whenever I say an important point, immediately jot it down, write it down, so that you can be able to remember for a long period of time. Now, so surcharge is 25% if the casual income is more than, if the total income is more than 2 crore but less than 5 crore, 25%. So 25% of 1 crore 5 lakh, it comes to 26 lakh 25,000. Add up 1 crore 31 lakh 25,000. Health and education cess as usual 4%. So 4% on this amount you will get 5 lakh 25,000. So ultimately the tax liability comes to 1 crore 36 lakh 50,000. That's it. This is the problem number 11. Now 12th problem you see. Sri Guru Raj is having income from long-term capital gain, LTCG. It's a special income on which there is a flat rate of tax of 20%. Write it down. So long-term capital gain 2,80,000 and 7,20,000 from other heads of income. Other heads of income means normal income. So this SSC is having two incomes. One normal income 7,20,000 on which slab system will apply. And next one is long-term capital gain 2,80,000 on which flat rate of tax will be applied, 20%. So separately, we cannot club both together, because on 2,80,000 there is a flat rate of 20%. On 7,20,000 there is a slab system. Come calculate the tax liability. Now see carefully. Sri Guru Raj, normal income, other heads of income is 7,20,000. Long-term capital gain, it's a special income, 2,80,000. So separately we have to calculate the tax. First we calculate the tax on normal income. Up to 2,50,000, income is 2,50,000. The rate of tax is nil, tax liability is nil. Basic exemption limit is 2,50,000. If nothing is given in the problem, we assume the SSC is a non-senior citizen. That's why 2,50,000. Second slab goes from 2,50,001 to 5 lakh rupees. So 2,50,001 to 5 lakh. The income comes to 2,50,000. The rate of tax is 5%. So 2,50,000 into 5%, 12,500. Next slab goes from 5 lakh 1 to 10 lakhs. But our income is not going to 10 lakh. Our income is only 7,20,000. So we'll take the balance. So 7,20,000 minus 2,50,000 minus 2,50,000, remaining 2,20,000. The balance remaining is 2,20,000, on which the tax rate is 30%. So 20%. 20% of 2,20,000. It comes to 44,000. Total tax is 56,500. The tax on normal income is 56,500. Now tax on LTCG. The long-term capital gain is 2,80,000, on which there is a flat rate of tax 20%. 20% of 2,80,000. 56,000. Total 1,12,500. Remember, all these provisions, whatever I am explaining, that is already there in the theory video. In the theory videos, I have explained all the provisions regarding the tax rates. So before watching this video, I suggest you to watch first of all the theory videos. Next, total 1,12,500. To this, health and education says 4%, 4,500. Tax liability 1,17,000. So in this problem, what new point you came across? Two incomes. Normal income, slab system. Special income, flat rate of tax. Separately we calculate. Next, 13th problem. Mr. Sri Karan Reddy, income details are income from business 8 lakh and income from long-term capital gain on listed equity-oriented mutual funds. Security transaction tax is paid 4,10,000. Calculate tax liability. First of all, again he is having two incomes. One business income is a normal income on which slab system will apply. The slab system will apply on 8 lakh. Next income is LTCG on listed equity oriented units of mutual fund. In the last theory video I have explained, if an SSC got long term capital gain on shares or equity oriented units of mutual fund, equity oriented units of mutual fund, if there is a long term gain, capital gain, it is exempted up to 1 lakh rupees. Exempted up to 1 lakh rupees. The excess is taxable at 10% flat rate. 10% flat rate. So here the SSC got LTCG from equity oriented units of mutual fund on which security transaction tax is paid. STT is paid. So up to 1 lakh is exempted. So out of 4,10,000, 1 lakh rupees exempted, not taxable. Remaining 3,10,000, flat rate of tax 10%. Separately we calculate. So first of all, we have to calculate tax on normal income 8 lakh rupees. First of all, income from business, normal income is 8 lakh. LTCG on listed equity oriented mutual fund on which STT, security transaction tax, is paid is 4,10,000. Now the provisions of Income Tax Act I am writing here. According to the provisions of IT Act, LTCG on equity oriented units of mutual fund on which STT is paid is exempted up to rupees 1 lakh. Up to 1 lakh rupees exempted. Remaining excess is taxable. The excess will be taxable at 10%. In our problem, it is given 4,10,000. Out of 4,10,000, 1 lakh exempted. 3,10,000 is taxable at a flat rate of 10%. So yeah, therefore 1 lakh rupees is exempted and 3,10,000 is taxable at 10%. That is the new point in this problem. So first we calculate the tax on normal income. Tax on normal income. First slab up to 2,50,000, income 2,50,000, nil, no tax, no rate. Second slab 2,50,000, 1 to 5 lakh, it comes to 2,50,000, 5% tax, 12,500. Next slab goes from 5 lakh 1 rupee to 10 lakh, but our income is not 10 lakh, our income is only 8 lakh. So we will take the balance. So out of 8 lakh minus 250, 3 lakh rupees remaining. On this 3 lakh rupees, 20% is the rate of tax. Remember 0%, 5%, 20%, 30%. 4 rates are there. 0% first basic exemption limit. Next 5%, next 20. If there is any, 30 also will come. Over 10 lakh. If a person is having income over 10 lakh rupees, 30% rate of tax. Now we have balance 3 lakh into 20%, 60,000. Take the total 72,500. 72,500 is the tax on normal income. To this tax on LTCG, we have written here 10% on 3 lakh 10,000, 31,000. Take the total 1 lakh 3,500. Add health and education says 4%, 4,140. Tax liability 1 lakh 7,640. That's it. So here in this problem you came across the new point regarding LTCG on shares, equity oriented units of mutual fund. 1 lakh rupees exempted, excess is taxable at 10% flat rate. Next. 14th. Mr. Nagnath, age 84 years, means super senior citizen, above 80, super senior citizen. The basic exemption limit is 5 lakh rupees. Income from previous year relevant to the current assessment year is income from other sources 5,25,000 and LTCG is 90,000. Calculate tax liability. Income from other sources means normal income and LTCG is taxed at a flat rate of 20%. Now see, age 84 years, super senior citizen. Normal income is 5,25,000 and LTCG is 90,000. So separately we calculate the tax on normal income and LTCG. Normal income, tax on all. First slab up to 5 lakh rupees. 5 lakh rupees is the income, rate nil, tax nil. Because super senior citizen, the basic exemption limit is 5 lakh. The first slab is up to 5 lakh rupees, nil. Second slab goes from 5 lakh 1 to 10 lakh. But our income is not going up to 10 lakh. So we'll take the balance. So 5 lakh 25,000 minus 5 lakh, 25,000 is the balance on which 20% is the tax rate. So 25,000 into 20%, 5,000. So 5,000 is the tax on normal income. Tax on normal income 5,000. Tax on LTCG, long-term capital gain is 90,000. 20% is the tax. 20% of 90,000, 18,000. So 23,000, add health and education says 4%, 920. 23,920 is the tax liability. That's it. 14th completed. Now 15th problem. An assessee's income from LTCG, long-term capital gain, is 14 lakh and income under other heads is nil. No other income. Only LTCG is having. Compute tax liability in each of the following situations. 4 situations are given. First, A situation, if the assessee is a resident male person. Second, B, if the assessee is a non-resident female person. Third, if the assessee is a resident senior citizen. And last, if the assessee is a resident super senior citizen. So 4 different cases we have to compute the tax liability. Only LTCG 14 lakh is having. No other income. Right? Now, LTCG 14 lakh. Resident male person. Resident male person, whether male or female, the provisions are same. So first of all, LTCG 14 lakh, from this we deduct the basic exemption limit. If nothing is given, we assume non-senior citizen. For non-senior citizen, 2,50,000. So deduct 2,50,000, 11,50,000 is the taxable LTCG. Taxable LTCG. So tax 20% of 11,50,000, it comes to 2,30,000. To this we add health and education says 4%. So tax liability is 2,39,200 in the first situation. Basic exemption limit is 2,50,000 deducted from casual income, from LTCG. Next, non-resident female person. Non-resident male or female, basic exemption is not allowed. Basic exemption is not allowed for non-resident person. So from LTCG basic exemption nil. So taxable LTCG 14 lakh. So 20% of 14 lakh 2,80,000. Health and education cess. Tax liability 2,91,200. That's it. The difference between first and second. For resident, basic exemption is allowed. For non-resident, basic exemption not allowed. Next, resident senior citizen. Resident, the basic exemption is allowed. Senior citizen, basic exemption is 3 lakh. So 3 lakh rupees would be deducted. Basic exemption 3 lakh. So taxable LTCG 11 lakh. So tax 20% of 11 lakh 2,20,000. 2,20,000. Health and education says 8,800, 2,28,800 tax liability. That's all. Next, resident and super senior citizen. Basic exemption allowed because resident, and super senior citizen means basic exemption limit is 5 lakh. So deduct 5 lakh. 14 lakh minus 5 lakh, 9 lakh rupees is the taxable LTCG. On this taxable LTCG 20%. So 20% of 9 lakh, 1,80,000. Health and education says 7,200. Tax liability 1,87,200. That's all. This is the end of problem number 15. So totally 15 problems are completed on this topic of computation of tax liability. Inshallah, we'll continue the next problem in the next video.